Hello everyone, it's Chris, and in this video I want to talk about Google because the company just reported earnings and the stock is down 4% as I'm speaking right now. You had a lot of moves. The stock went down just after earnings and then went up a lot and then down a lot. Basically, it was a very good report, but the capex was a little bit frightening. So in this video, I want to share my opinion because I own Google, give you a little bit of an update of if I want to sell more of this beautiful company that is reaccelerating. And I want to comment on specific things in this report that I think you will like. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And full disclosure, I own Google. The stock went up so much, it has become 15% of my portfolio. I've been a shareholder since 2018, and when it became too big for me, like 15-16% of my portfolio, I trimmed it. So now I trimmed from 16% of the portfolio to 11% of the portfolio, but still it's my second largest position. And to be frank, this report gave me more reasons to sell more shares because of the way it's going and the guidance. So let me do a quick recap of what's happening with Google. Basically, all the segments are in a good shape. All the metrics are up and to the right. I want to mention some Twitter articles, great Twitter articles about what is happening with the search. Look at the revenue that is reaccelerating. Google search reaccelerating 17%. The revenue is in good shape. The revenue is reaccelerating, as you can see here, despite all the heavy capex. You have a business growing revenue at 18% per year. With the size of Google, it's quite phenomenal to grow at such a high rate and to reaccelerate when you become so big. At the same time, if you look at the other metrics of the business, you have gross margins that are stable, increasing a little bit. You have operating margins that are increasing. I don't know how they are doing it, but on a year-on-year basis, the margins are not increasing but stable. They are operating at a very high level, and despite all the heavy investments, more investments in R&D, for example, that is growing fast, the margins are spectacular. And this is something that was worrying for the past decade of Google, how such a profitable business was only enjoying operating margins of 20% per year. You had the legendary investor Terry Smith that talked at great length about this problem. And then in COVID, Google decided that they wanted to win hard. So since COVID, the operating margins increased a lot, from 20% operating margins to 30%. And now they are doing everything they can to sustain 30% operating margins. Despite all this cost with AI, they are doing it. So it's the proof of a business model that works. So you sustain your high margins and the business reaccelerates. And if you look at the different segments, I showed you the Google search reaccelerating. Google search, so the main revenue stream for Google, up 17%. You have the Google Cloud growth that is reaccelerating. Actually, look at this. This is the Google Cloud growth for the past 4 years. You see that in 2021, when people were enjoying lockdowns, stuck at home, the business was growing 40% per year. Then everything decelerated to 22% and people called Google dead. And now look at this. We had 48% growth in Google Cloud. Keep in mind that at the same time, Microsoft Asia is growing 38%. So at a moment where Microsoft is decelerating a little bit, becoming stable, it seems like Google is reaccelerating. One clear differentiator between these two companies. You can always spot patterns. Look at this. For Asia, for Microsoft, it was really high, then low, then high again, but not reaccelerating. For Google, it was high, low, and reaccelerating. So maybe Google is doing something that Microsoft is not doing.
By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video.
At the same time, the cloud segment is becoming profitable. Google Cloud just reported 48% revenue growth. That's their fastest growth rate in more than 4 years. Look at this. In blue, you have the revenue, and in green, you have the operating income. Before 2023, this segment was unprofitable, and since 2023, it has become profitable. And actually, you can calculate the margins of this segment on custom metrics here. The Google Cloud operating margins, I created this custom metric. So the profitability of Google Cloud that is reaccelerating. As you can see here, in 2020, 2021, 2022, 2023, unprofitable. And then they became profitable, and the margins are just going up and to the right. Operating margins of 10%, 15%, 20%, and now we are at 30%. So we are talking about a business segment that is quite recent, that is reaccelerating at 50% per year, and you have the most profitable margins you ever had. That's very, very bullish when it comes to Google. Okay, so extremely well-run segment when it comes to Google Cloud. And in terms of importance, I want to see the split. How important is Google Cloud compared to the overall profitability? Google Cloud revenue common size. Okay. The purple line you see, that's Google Search. What is the importance of Google Search compared to the revenue? You see that Google Search represents now 55% of the total revenue for Google. And Google Cloud, in the past, it was 7% of the revenue. And now it is growing and growing and growing and growing. So you have now a segment that has become 15% of the revenue. And it will continue to grow. What if this cloud segment grows and become 20-25% of the revenue? Because this is growing so much, it will lift the overall margins if the operating margins continue to go up. So there is a scenario where the overall margins of Google go up a lot. We've seen before 30% operating margins. Maybe there is a scenario where the margins will go up to 40%. So Google is showing the world right now they have the potential to grow a lot, to reaccelerate, and to become very profitable in the future. Great signs, right? Great signs. And it is also showing that the big capex plans that you are having right now is working exactly like Meta Platforms is saying. If you look at Facebook, Instagram, Meta Platforms, they are investing a lot in capex. But is capex worth it? This is the big question. Is this just a burn of capital, or are you really using the capital? And the only thing that matters for this capex is, does it re-accelerate your growth in revenue? You see in orange the growth rate of capex. It's just going high and high. I mean, the capex has doubled. And you see in blue the revenue. You can see, I can show you on a quarterly basis. What can I show you? You can see that the blue line, the revenue line, is re-accelerating slowly but surely. So far, the business is spending a lot in capex. So far, it is kind of working. Actually, this result is worse, weaker than Meta Platforms. For Meta Platforms, you have a revenue growth rate more than 20%. You had like 26%. So for Meta Platforms, I would say it's a better use of capex. But for Google, you kind of have the same trend of re-accelerating revenue. If you go to Twitter, I can show you this tweet from Fiscal AI, because the business Google just announced more capex. This trend will continue. Our 2026 capex investments are anticipated to be in the range of $170 to $180 billion. Look at this trend. For the past 20 years, they expect the business to double its capital expenditures for 2026. This is getting crazy. This is getting ludicrous. I mean, what are the cash flows of this business? What are the profits of the business? On an annual basis, How much do you generate? Common size. On an annual basis, for the past 20 years now, the business has a net income of $130 billion. And they expect the capex to be more than this. Look at the net income, look at the capex. You see that the net income is going up and to the right, and the capex is as accelerating on an exponential basis, I would say. And they expect the capex to double. Do you really think the net income will double in 2026? I don't think so. Which means you will have to require debt for 2026. And this trend has already started. If Google cannot finance their capex because of their cash flows, they will have to go into the debt market and take on more debt. You can see here the long-term debt. In the past, Google was famous for having zero debt, almost zero debt, $2 billion of debt. In COVID, they took $10 billion of debt. And now if you look at the latest data, the debt level went from $12 billion, $10 billion, $20 billion, $40 billion. I'm highly convinced that this trend will accelerate massively to finance the capex. Google had a reputation, I say had because that's something of the past now, had a reputation of having a pristine balance sheet, a perfect balance sheet filled with cash, with minimal debt. It is no longer the case. You have a clear change in business. Now the company has a lot of cash, right? You can look at the orange line, that's the cash, blue line, that's the debt. So far, no problem. But in 1 year, 2 years, you will have much more debt. The blue line will go up immensely, and the blue line will generate interest expenses, additional costs that you will have to finance. So maybe margins will take a hit. So I told you at the beginning of the video, margins can go higher, but maybe the cost of debt will reduce guidance, so will reduce margins, so the overall margins may not increase. At the same time, if you have massive capex, you have depreciation amortization, which are a cost. So maybe margins will go down in the future. They will not go up immensely because of all these massive costs. I wanted to highlight this. And actually, I don't like their guidance for capex. They are guiding for a double in capex, and I don't like this at all. I want my portfolio to be filled with quality compounders. You can check my portfolio. By the way, my portfolio is public on eToro. You can check any day of every waking hour my portfolio live, full transparency. You can have a link in the description of my YouTube videos. I want my portfolio to be filled with quality companies that don't require much capex to grow, that are deadly efficient. The more I look at it, the more Google is being disqualified from my portfolio. I'm keeping it as a core holding because it's an AI winner, and usually it had been a mistake to bet against Google. The business is reaccelerating, the management team is good, the segments have a wide moat, so it's a quality business. For the moment, I don't think I will sell. For the moment, I think I will hold. Wait and see. But if I see a better opportunity, I will keep trimming. I already trimmed a little bit of Google because of the capex, and now the capex increased even more. So I'm even more and more seduced to trim and to reallocate these gains, because I'm highly in the positive, take these gains to asset-light businesses. Because now everybody is optimistic when it comes to Google. The stock has been going up and up and up and up and up for so many months. People are extremely bullish and the results are good. What if, for some reason, the results decelerate? We enter a recession, or the AI build out is not going good and well. What if the capex is too much? What if the profitability falters? If there is one thing that is negative, it will trigger all the negative things. And maybe all the capex from all the companies, everything will fall down, and the high multiples will not be deserved for all these companies. If you look at the valuation for for Google right now, you can look at, I would say, two ways. Two ways are that's good. You can look at the normal PE ratio, look at the price, look at the multiples, that's fine. Or you can look at another way, the PE ratio if you exclude the investment gains. I want to give credit to Arya Radnya that created this metric. So that's his metric. You can check his YouTube channel, great quality content. And you maybe want to adjust for the equity gains you have in the income statement. Meaning, the real core operations of Google have a PE ratio in orange that is at 37. Now maybe it will change because of the guidance, new earnings, and the stock is down today. Fair enough. It's more than 35. Right now, I am seeing opportunities, stocks that have minimal capex and that have a lower valuation. So you have other opportunities if you want to trim Google right now. Google is not cheap at all. Even if you look at the normal PE ratio, Google is not cheap at all. A few months ago, the stock had a PE ratio of 20, pretty cheap. Now we are around 30, even if you account for all the investment gains. The normal PE ratio that everybody looks at. So you are in front of a winning company, more capex, reacceleration of revenue, PE ratio of 30. We are not excessively high, but we are a little bit high compared to average. Okay, this is not a deal. Now I want to mention something else that was pretty good for all the companies. The comments that the CEO of Google said. It's a great tweet from Amit. Sundar Pichai, on the recent SaaS meltdown, he was asked a question about software companies. Here is his answer. AI is going to be an enabling tool for software companies. We are seeing massive token usage. Many companies are incorporating Gemini into their workflows to increase productivity. Software companies that are utilizing AI have big opportunities ahead. Basically, Sundar doesn't think AI is going to destroy SaaS. When all the SaaS companies, software companies are going down, Wall Street is selling and asking questions after, the CEO of maybe the most important tech company is telling the world that don't worry guys, AI will effectively improve this industry more than destroy it. An incredible set of these companies today, software relative to the S&P 500 shows 6 years of relative gains wiped out in the past months. All these software stocks are going down massively. And the CEO of Google is telling you that actually AI will give much more opportunities for the software companies. AI will not destroy all the software companies. The big question for us investors is to differentiate who will be the winners out of this AI drama. Which one of the software stocks will win and enable AI and monetize AI? Okay, this is the next question. So yeah, pretty good report. I'm not surprised the stock is flat. I would not be surprised at all if the stock is up or down. Now people are a little bit euphoric when it comes to Google. But the more I look at it, the more I look at the capex figure, the less I like the idea. Because if the costs are going up massively in 2026 and the capex is going up massively in 2026, what will be the capex line in 2027? The capex will be just immense. And Google, that was known to be asset light and efficient, is transforming itself to a capital intensive business. You can use fiscal AI, capital efficiency, and look at the capex to operating cash flow here. By the way, I'm using fiscal AI. If you want to use fiscal AI, you have a discount code in my description. You have minus 15% if you want to use it. It's a great website. You can use all these charts. Look at this. For the past 20 years, okay, I can look at the quarterly data, last 12 months with the smooth things out. For the past 10 years, this has been the capex of the company compared to operating cash flows. Fluctuating. During COVID, it was like 0.3, so 30%. And now look at this trend since AI. Since AI and since ChatGPT, the capex to operating cash flow has gone from 30% to 40% to now 56%. So the business is using the majority of its cash flows to fund this capex. And I don't like this at all. I would rather invest in businesses that are allocating all of their cash flows to do buybacks, like MasterCard or MSCI or FICO. So yeah, maybe in the future, this line will be to 60%, 65%. How high can it go? I don't know. You don't know. Nobody knows actually. Even the CEO of Google doesn't know. Very interesting to see what is happening here. Something to really monitor. But yeah, I think it will. The majority of the cash flows are going to capex, and now they are planning on doubling the capex expense. So for 2026, this will go much higher. For 2026, it will be above 60%, I believe. So yeah, something to monitor here. Maybe I will keep you updated, but this was a pretty strong report from Google. You have some things to monitor for 2026, but of course, it will be a very interesting year for Google.
If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.